Hey, welcome back, everybody. Really excited because we do have Lior Gantz back on the channel today. This is the third interview we've had the pleasure of doing with Mr. Gantz. So let's go ahead and get started real quick, talking about a few of the topics you can expect going forward. And they do include the recalibration on Wall Street and through all the markets that we're seeing as we move away from that low interest rate environment and the risk of deflation and more towards inflation and the possible risk of recession coming up. So we'll talk about the Chinese impact, Washington's impact, and the difference between the Fed and our elected officials on who caused the problem and what they can do to fix it. We're also going to talk about the transition away from tech and future value to investing in more present value commodities and companies that do things for us now, vice in the future. So if you're interested in all that, you want to learn about how this is going to impact gold, silver, and the overall equities market, then please stay tuned. Let's get to the interview. Hey everybody, welcome back to the channel. I am very fortunate today to have Lior Gantz back with us. This is actually the third interview we've had the fortunate pleasure of having with you, Mr. Gantz. Thanks for being here today. As an accredited investor, I know that you follow the market very closely, all realms of the market. So much has been going on over the last 6 months since we last spoke. I'd really like to jump right in with what you're seeing with the overall equities market. It appears that it has spread into all markets, actually, this global sell-off and talks of recession. So first of all, welcome. How are you doing today? And let's talk about the market.
Yeah, definitely. I think what we're seeing in 2022 is something that we see every 10 to 20 years. And that's where Wall Street and the entire investing world recalibrates what it holds dear and what it neglected for a period. So this is sort of a paradigm shift. For the past 13 years, what we've been accustomed to seeing is a Federal Reserve and a central bank policy around the world of keeping rates zero bound, or even negative in real terms in many countries, seeing slow growth and the threat of deflation waved at us at all times. So in other words, we'll print currency and we'll help with bond purchases and monetize with QE all the time. Because if we, the central banks, are out of the markets, then there are very strong deflationary forces out there, and the economy will slow down to recession. That's sort of the theme that ran for 13 years. It started to change a little bit with the election of Trump, because they raised rates at the same time as Brexit, at the same time as economic outlook started to look really good. We had people coming from the sideline, people that weren't working for years and years, came back because the jobs market looked very healthy, wages were going up. This was a very inclusive recovery from the 2008 scenario. People started to trust mortgages again, so the housing market started to come back real strong. And we had something called a Goldilocks, where the growth is good, but not too hot. Inflation is 1.5, 1.6, 1.7, but not crazy. And so things look great. It's a Goldilocks period. But what happened is the healthcare crisis in March 2020 changed everything. The Fed initially believed that once we get over this situation, then we'll see the resumption of the same trends. In other words, we'll see the world go back to what it was in January of 2020, before this became a global-wide phenomenon and everything like that. And that didn't materialize. For the entirety of 2021, they kept saying that inflation is transitory. The reason they assumed that is because they thought that the global trends that have held so strong for 13 years will continue. The globalization will continue, that the way we operated is going to stay just about the same. They didn't understand a lot of the behavioral changes that happened in the workforce, in migration between cities and states in the United States, the new way that China was thinking about globalization and the world and how it wants to operate in the world. And so it became a situation where after the Delta variant in August of 2021, even the last straw or the last thing that they held on to, that is that inflation is a transitory phenomenon, even that proved to be a problem to keep saying, because even though therefore you cannot treat it that way. Even worse, it wasn't transitory. It became entrenched. It became something that we see in shelter, in wages, in products, in supply chains, in food and energy. And so they switched the whole thing. And once they said that they're switching, once Powell said inflation is no longer transitory, we can never treat it as transitory from going forward. And in January of 2022, went in front of the Banking Senate Committee and really told them the truth, like really told the market the truth. The paradigm started to shift. Mm-hmm. The people started to understand, algorithms were rewritten on Wall Street to understand that we are not in a slow growth, low inflation world where CEOs can raise money and promise that there will be a bottom line in 5 or 6 years. As long as you trust our company, we're going to grow revenues, expand, and we're going to keep losing money. Because don't worry, inflation is very low, interest rates are super low. You're buying growth, and that's fine. Well, that became no longer fine, because if there's real inflation out there, and if companies and if investors do not care about seeing the bottom line in 5 or 6 years, they want to see now profits, then you cannot hire thousands of new people to just focus on growth. You need to focus on margins and the bottom line. And that's a new shift in paradigm. So a lot of sales, a lot of companies that were sold off were getting sold off based on this new theme that their business model needs to be rearranged altogether. And if you're an algorithm or an algorithmic trading computer, you simply make decisions based off of criteria. So if the criteria is, hey, if this company doesn't have profits at the bottom line projected for 2022, sell no matter what the price is, then you get a freak year like 2022, where you see the worst year for stocks in the past 5 months. So January till end of May, this has been the worst stock market since 1939. And for the bond market, it's been the worst bond market since 1920.
Yeah.
So this is a freak year. Now we need to figure out like what's happening here. So some companies have been sold off way more than they should. In other words, there are opportunities out there. Some companies are now only getting to where they're fairly valued. And some companies are still overvalued. But in general, what happened is that we had a loss of a wealth effect. Because if 150 million people in the United States alone that have pension funds, retirement accounts, brokerage accounts, if they all felt a 15 to 30% reduction in their paper equities, then this really starts to trickle into your real life. Now you start to think, maybe I should not retire this year. I just lost $200,000 on paper. Can I retire? Can I not? Should I buy those new appliances? Should I do this renovation? Should I get into that bigger house? All these questions come into play, and that's what the Fed can do. It can alter your behavior or influence your behavior using the wealth effect. Yep. That's one thing they can do, right? They can make mortgages more expensive. They can make the market less appealing, but they cannot change a lot of the factors that go into your food and energy, because that's what the government can do. The government can help ease problems with supply chains, with oil, etc. But the Fed cannot help that. the Fed also cannot help a shortage in housing. So the fact that you said I'm not going to buy a house doesn't change the fact that you're still going to pay very high rents because you're okay. So we have many problems, both in housing and otherwise, that are way more dependent on a functioning administration in Washington than on the Federal Reserve raising rates. You can raise rates till 8 or 9%. You can kill inflation altogether, but you have a deep depression. So the game here is to try and create what's called a soft landing. But even if you do a soft landing, which is slowing down the economy but landing the plane smoothly, and not a hard landing, which is basically creating some sort of a slowdown or recession while you do this. No matter how you look at it, you're going to land the plane. The vacation is over, and so what we're seeing basically is a revaluation of equities and real estate and whatnot to the present value. Whereas in the past 13 years, people have invested using the future or the growth prospect of companies and anything else that they were looking at as their barometer. Now people care about today. This is way more of a mentality of value investing, like there was in the Great Depression, or after the Great Depression, I should say, than in boom times. So we're definitely moving to that world of valuing things. Show me now. I don't want to hear your promises of how this company is going to disrupt anything. I want to see how you make money now. So this is one thing that's important to keep in mind. So we are going to see valuations compressed, and therefore appreciation is going to be less and less important for investors. And what's going to drive returns is going to be dividends and buybacks, the real stuff, not just appreciation of multiples. Okay. So that's the stock market. I don't think we're headed into something that's similar to a dot-com bubble bursting. I think we're already seeing that. Like the equities that should have fell by 80 or 90%, they're down 80 or 90%. Okay. So that's one thing. And just remember, the plane is in the air, right? So, and it has fuel. So we are the ones that are trying to land it. We're the ones that say, hey, this vacation has gone on long enough. It's not like there's a real problem with the plane. It's not like, there's the engine doesn't work or anything like that. The plane's fine, but we're trying to be responsible and land it. Yeah. So this is not like, all these banks have sold toxic securities and mortgages and blah, blah, blah. The entire world is coming down. The entire system is going to collapse like 2008. And it is like the dot-com bubble in terms of there was a lot of froth in the markets. But, if you look at the NASDAQ 100 today compared to the NASDAQ 100 of, the 2000 crash, I mean, it's not even the same. The NASDAQ 100 today, if you go over these companies, these are world-class companies. In the dot-com days, the NASDAQ 100 was penny stocks. So very big difference. I know people like to compare the two. I think in investor mentality, there was a lot of hype in both periods, but the impact of how much these equities can go down is different because these are real companies that are driving the big indices. So, okay. So that's one thing. Now let's look at what's happening going forward.
Okay.
You do have real changes in the world. Globalization has, I don't want to say ended, but it's definitely changed a lot. Okay. So, and by the way, for your viewers and listeners, because I know that you have really educated viewership and people that watch your show want to know more.
Yeah, great.
I created a great reports for you to download. So it has more data, stats, graphs, charts. It's free, obviously. You go to wealthresearchgroup.com/pain, PAIN. wealthresearchgroup.com/rug, like a rug pull, RUG, and wealthresearchgroup.com/bear. And I think if you download those three reports, these are very, meaty, juicy reports. One of them is about the housing crisis and what's happening there. The second one is about the prospects of a recession. And the third one, the rug, is about situations where the indices, or I should say the S&P 500, which is the barometer for bear markets, fell by 19% but didn't actually go to minus 20. What happened in those near misses that happened in the last 100 years? Is it the same statistical pool? Is the next 12 months to 24 months the same as a real bear market, or is it different? And you'll be surprised to see what happens, because what we saw here this year is the S&P 500 go down by 19.8%, but not quite 20%. And so it puts it in a very different statistical pool, and you'll want to see what happens after these near misses. So /wealthresearchgroup.com/bear/pain and /rug, and I think you'll really enjoy those. So to talk about China is now realizing that it doesn't want to serve as the manufacturer and producer of everything and anything for the rest of the world as it did for the past 30 years.
Yeah.
We have to realize something. The 500 million farmers, the rice farmers and whatever else China had that came to the urban centers and became workers, that's gone.
Yeah.
China has peaked in worker capacity in 2010. We are now 12 years later. They do not have the workforce to supplement globalization anymore. So keep that in mind. That's really big. The biggest thing that China had was that they can replace an American with a farmer, and that is gone. Secondly, China understands that it has a few demographic problems and a few internal problems, and they have the Taiwan problem. The domestic problem they have is that they're not producing enough children to supplement their elderly population. In other words, the taxpayers are that bracket, the productive part of the society, is not growing fast. In the United States, it's really good, but China, not so good. Secondly, in terms of how they look internationally and whatnot, they have taken the side of Russia in this conflict, and therefore they're creating like their own bloc. And third, we have the Taiwan situation. Intel, NVIDIA, and all these other American chip giants, they've in the last 20 years, they've put a lot of money into R&D and design. So they design their chips, but they've outsourced the manufacturing into a Taiwanese corporation. And that corporation is now the most important chip corporation in the world, and it resides in Taiwan. And both the US military and the Chinese military are solely reliant on the chips that they manufacture, which are superior and faster and smaller than the one that Intel and Samsung and all the competitors manufacture. And that's a big deal, because whoever controls Taiwan controls the world, because the technologies are super sensitive. Keep that in mind. And so that's what we're facing. And we're facing not only the end of globalization, but this real problem between China and the United States, and it's not going to change. So I see in this decade, I see inflation higher. I see workforce situations where Americans are going to be needed way more in jobs. And you can see it now. There's 11 million openings and 6 million Americans looking for jobs. You have a lot of jobs coming back to the United States because China cannot deal with it. Plus, a lot of CEOs, they cannot tell their board that they haven't changed anything in their supply chains and made them more localized. And third, and this is the biggest one, you have the dollar coming into question, because will China try to create a competing global currency to the dollar? I'm not saying it will replace the dollar. I'm saying they'll try to compete, and we'll have two blocks, basically. They'll try to turn a lot of nations that are more closer to them to use more of the yuan than the dollar. So these are three major things that I think are happening.
Wow, that a lot going on there. So just to kind of recap real quick, the plane is in the air. It's coming down. It's been turbulent, and Jerome Powell and his team are flying the plane, and they're doing what they can to soften the landing for us all.
Yeah. The co-pilot Biden is dysfunctional, I should add, in this scenario, right?
Yeah. I mean,
the Fed is trying to land it on its own. It's blaming Washington for not helping.
Yeah, I definitely see some differences going on there, and we're 6 months from the midterm elections, and things aren't looking super hot for the incumbent president and his team. Based on recent polling, I saw yesterday that only Massachusetts, Hawaii, and Vermont, only 3 of 50 states, is he polling more than 50% favorability. So definitely an interesting time. Also, the chip shortages, big impact here to the United States. A lot of people that aren't even into high-tech stuff like computer graphics cards, et cetera, they're feeling it too, because when they go to order a car or a tractor or any kind of machinery that requires any kind of a chip, a lot of it does indeed, which makes the conflict in Taiwan much more different than the conflict in Ukraine. Speaking of the conflict in Ukraine, though, Lior, how do you see the impact on commodities such as gold and silver, which we're heavily focused on here, with everything that's happening with oil today, namely with the conflict in Ukraine?
Look, in terms of how gold and silver will perform in a world that's moving towards some sort of a stagflation, usually they do very well. One is the dollar is really strong right now because of what's happening in equities. When you sell equities, any equity, you settle it in dollars. So the demand for dollars right now is huge. But once the risk on environment comes back, we're going to see a real sell-off in dollars. You're going to basically turn your dollars into equities, bonds, stocks, real estate, etc. Very similar to what happened after 9/11. A lot of money flowed into dollars and then it flowed out. The same thing happened in the pandemic. The dollar went to an all-time high in March of 2020, and then you saw what happened with gold and silver right after. They shot to all-time, gold did to all-time highs by August 2020. I think we're going to see something similar. You're going to see, first of all, rallying gold and silver, specifically silver, which is much more damaged by dollar strength. Gold, not so much. Gold and the dollar can rally together a lot of time as competing safe havens, because for institutions, the dollar is a safe haven, like it or not, and joke or not. Okay, so I think gold is going to about 2,500 in this cycle, and I think silver can hit in this cycle in the high 40s. So that's in the cards for me during what we're going to see in the next few years. So my outlook has not changed for them. I'm very bullish.
It seems like it's been a good place to be during this downturn is in gold, not so much silver.
Oh, absolutely.
I mean, we talk about it all the time. Silver is much more closely tied to the economy, much more industrial application than that of gold. So I mean, it's pretty easy to witness. GSR is not necessarily up where it was. I mean, we saw 120 to 1 back during the beginning of the health crisis, and now we're looking at 85, 90 to 1. So thank you. That's good information for my viewers. As you know, many of them are longtime buyers and holders of gold and silver, and so that's very important to them to understand. I did also want to talk real quick about the currency issue that you discussed. As you know, there are countries out there that have been making remarks lately about moving away from the dollar as a reserve currency, and so if that happens, if you see China and maybe countries like Saudi Arabia, for instance, that are looking to increase oil production and also meet China's demands for oil more so than even the United States, which is a shift. Then how do you see the impact to commodities, stocks, if the world does begin to move away from the U.S. dollar as the reserve currency? Do you see any kind of disruption there?
Well, we're seeing gradual de-dollarization for almost 20 years now, since the euro became 20% of global currencies reserves. So it's already happening. The United States continues to be the motherlode in terms of opportunity and innovation and technology. So it remains the dominant dog. It definitely is the greatest economy and the greatest country ever in terms of capitalism and enterprise and whatnot. But it's no longer the only dominant country. And that's important to keep in mind. China is way bigger. India is going to be bigger during this century. You're going to have countries like Nigeria and Indonesia that they're exploding in population, and they're going to be very productive during this century. So, America is going to be America. It's a phenomenal place. The rule of law, there's nothing like it. In human history, there's never been a country that is so pro-business. But it's going to have competitors this century, and the dollar will become less relevant as a global reserve currency. I don't see it going, to become worthless or stuff like that. Like I hear a lot at times that people are predicting like hyperinflationary stuff like that. I don't see it. There's no example in history of a country as developed and diverse and complex and beautiful as the United States turning its currency to zero without some insane event to come before it. So I don't see that, but I do see problems for the U.S. dollar in terms of continued loss of value relative to real world assets, and that's what's going to drive commodities higher, the dollar higher. I'm sorry, gold higher, equities higher, etc. So I do see that savers are going to be continue to be losers, but it doesn't mean that you have to immediately deploy every dollar you get, because you always should have cash around. If the dollar loses 4 or 5% a year, that's a lot. But stocks in a year like this can lose 30%. So you've been much better off in cash this year, and now having this dry powder to buy stocks on the cheap than to have everything all in. So just remember when Ray Dalio says something like cash is trash, he just means that in a general way. But look at Buffett and look at all the big ones. You keep dry powder for opportunities, and obviously Dalio does the same thing. Yeah. So just keep that adage in mind. He says that, but it doesn't mean what he says, per se. So yeah, that's important. I think Russia and the Ukraine is a very big problem, but it's not as big as you think for the global economy. The global economy can adapt to what's going on over there.
All right, so we had a little technical difficulty there. We'll go ahead and get started back with where we were at. So we were talking about the war in Ukraine and the impact on commodities. Namely, there tends to be a discussed frequently the price of oil and the price of gold. And we're seeing oil just really, really get higher and higher. And I think there are those that are out there kind of expecting gold to do the same. Do you see a correlation between those two today as in the past?
It's oil is going up because of reasons that have nothing to do with why people and institutions buy gold. So I don't see a big correlation between the price of oil and the price of gold. There's a bigger correlation between mining stocks and the price of oil.
Yeah.
So that's more of a those impact each other. But I think what you're seeing in general is the vulnerability and fragility for the first time of big tech. When you have part of the FANG complex, Netflix, down by 70% in 1 year, Facebook down by 50% in 1 year, Apple, Alphabet, which is Google, Amazon, they've all gone over 20% down this year. You have Tesla, AMD, Nvidia, Adobe, Intuit, like all the big companies in the world, JP Morgan, really taken seen as fragile for the first time in many years. And so the public's opinion of tech has definitely changed. And that is part of the reason I think that investing in commodities is going to be much more popular, because the biggest correlation is tech and commodities.
Yeah.
When tech is up, commodities have really bad years, and you can look at GDX, GDXJ, even the TSX venture exchange itself, and how much has gone down since the bull market for mining stocks ended in 2011. So I think that's a big change. ESG, or all of these regulations that constrain mining companies, is going to create a situation where mining is going to be more expensive, commodities are going to be more expensive, because if you have to have reclamation costs because you create a mine and then they want you to basically restore nature to exactly what it was before you took, that costs hundreds of millions of dollars.
Oh yeah,
if not billions in some cases. That's one thing. Secondly, mining has become a political industry where you don't mine like in capitalism from the cheapest source. You mine from a source that you rely on. And that means that even if it's more expensive, you're going to pay to drill in Nevada, for example, not in Latin America.
Yeah.
And doing that, creating, and you can see a classic example with Twitter. Elon Musk buying Twitter is not a business transaction. It's a personal thing that he wants to have. He's made business a political thing. Just like Bezos with Washington Post and other purchases that people make. So mining has become the same thing. America cannot rely on Chile for all of its copper or stuff like that. It's going to need to come from reliable sources, even local sources. So that's why I think commodities are going to go higher in price, because you've created a situation where you don't go for the cheapest source, but for the most reliable source, and those tend to have a premium on them. Labor can be higher, regulation can be more costly, the time to put mines into production can be lengthier because of more regulations and environmentalists and whatnot.
Right.
So this is something that's going to happen, and it makes mining a more attractive industry, because it creates a problem for the demand side. I'm sorry, for the supply side. And lower supply obviously raises the price.
Oh yeah.
Thickens the margins and deters competition. Because can you imagine being a big oil executive right now, and the government sends like the little officials to fine you on anything that you do? That's why there's not a lot of big projects in America right now for oil. It's because big oil executives, they understood that the Biden administration cares more about ESG than about the real world. That's why uranium has done so well.
Yeah.
Because there was literally a shortage of energy in the world, and oil wasn't enough. So
yeah, lithium and uranium have all had pretty good couple years.
Yes. So I think that continues. That continues, and I won't be surprised to see the government intervene even more and damage those industries even more to create higher prices, and by an unintended consequence of their actions.
I personally, Lior, would expect at least another 2.5 years of volatility before we go into another change period after the 2024 election. And it just seems that you are absolutely correct that the big industries out there, they're looking for more favorable environments to work in when it comes to oil. And then the point you made about it seems that the market is transitioning to more of value. What can you do for me now? Vice these large price to earnings ratios that we've seen over the past 5+ years, where you're looking at future growth and investing for future growth aspects. So getting more back towards value. And if we're getting back towards value, wouldn't that, in your opinion, be something good for the mining industry?
The last time we had value over tech was the 2000s, and it was phenomenal for the mining industry.
There you go. Yeah.
So that's one thing. I mean, if money's exiting tech, it gives a chance for mining. And mining is a very simple business to understand. It's really a now business. You mine it for X, you sell it for more. There's a bottom line. There's a dividend for the big miners. There's mergers and acquisitions. That's how mining becomes exciting, because if you're a big producer, then the institutions flock to your bigger and better balance sheets. And if you're a speculator or a smaller investor, you're looking at which company can be bought out for next. And just keep in mind that the big companies, their priority is to replace depleting project. So if in the junior miners world, in other words, the companies that are not producing yet, they're developing, or they have a small mine, for a big company to buy them, the price is not their main objective. They're not going to try and negotiate for years, because what they really care about is your project is rare. So they'll pay a big premium. And you'll see sometimes companies that trade for X, and overnight they'll be acquired for 100% more or 50% more. Or if there's rumors that a big company is looking at, the stock can rally by 300, 400, 500% in the months leading up to the transaction. Just keep that in mind, because this is the potential that exists. You don't invest in mining stocks, which are super risky and very volatile and up and down and boom and bust, if you're not going for the huge potential wins. So that's the only reason to dip your toe in the water with those.
So, Lior, back to your reports here real quick. I will, and by the way, to all the audience out there, I will have all of those reports linked in the description section down below. Simple click and you can access them, and they are free. Do your reports talk about what you see as the what's next? Trying to help any of the viewers here today with preparing their portfolio for what's next, because in my opinion, Lior, yes, I saw the flight to cash. I witnessed it. A lot of people moving out of equities, moving out of cryptocurrencies, and going to cash. But I don't see them staying in cash for too long, right? You would ultimately want to deploy that cash as sectors begin to turn over, right, where there's more favorable earnings in other sectors. Do your reports help us with the what's next?
First of all, the best way to follow what's next is our newsletter. So that's where I literally
there you go
talk about what I do and what I do with my own money all the time. So I would say if that's your main objective, then you can freely subscribe to the newsletter. And it's basically 3 times a week. I ingest everything that I've studied and learned, and I put 3 articles out there straight to your inbox. So you can go to the homepage and subscribe for that. The 2022 Outlook, if you go to wealthresearchgroup.com/2022, that is something I put together. That's an outlook for the entire year. And for my 11 catalysts for gold to hit $2,582, you can go to wealthresearchgroup.com/11, like 11, and download that. But for sure, the newsletter is where it's all the time. And it's the most current. It's like almost like having an interview like this 3 times a week, but on a 5-minute read.
There you go. That's kind of stuff that's more up my alley. I like to look at it like a playbook, right? You gotta have a play for each situation. I'm talking sports here, but you're marching down the field as a football team. Obviously, you want to gain ground with each play, and there's a lot of people that just want to buy and not look back, and that's good, and not to be bothered with finances. I'm the kind of guy that's more hands-on, and I know there are viewers of my channel that are also more hands-on, and they're looking really honestly to try to squeak out wins even when things are stacked against them, and that's kind of where I'm at. where a lot of people were probably at with all of the sell-off that we just went through. So that was important for me to ask you, what kind of help that Wealth Research Group can provide my viewers as far as what to expect. You saw a lot of this coming. We talked a lot about a lot of this 6 months ago, and it's really played out. And I'm just want to highlight those articles that my viewers can access in order to gain insight and to gain an advantage for the weeks, months, and the rest of the year ahead. So
I'll leave you something optimistic for the conclusion. Gold has never gone down after a third rate hike.
Wow, yeah, we barely even got to touch on the rate hikes, and there are more to come.
Yeah, the third one is coming in June 15th, so in 12 days from now. Gold in 6 previous rate hike cycles, in the 70s, the 80s, the 90s, the 2000s, and the last one in 2015, till 2018. There's never been a third rate hike where gold has not rallied, gold and silver have not rallied subsequent to a third rate hike. So keep that in mind, and we'll definitely touch on that in the newsletter.
Absolutely, yeah, and I'll be looking to potentially take advantage of that, because I do have funds on the sideline right now. Curious to know if I should be dollar cost averaging into some of these tech stocks which are oversold, or if I should be looking at more value opportunities. And so I'll take a look at the newsletters and develop my own opinion based on that research and go from there. And I encourage all my viewers to do the same. Once more, we'll have all the links down below. Lior, you've been a great help to this community for many years. This is our 3rd conversation, and I've had this channel going for 3 years. I'd really like to thank you for your time and for all of your insight. I'd really like to talk with you again soon too, especially as we see some of these more micro interest rate hikes coming from the Fed, and see how your team and those that you work with see the market going in the future, and report on that again here for my viewers to keep them informed. Anything else, Lior, you'd like to say to the audience today?
No, we've covered a lot.
Yes, sir. Hey, thank you again. Thank you to all my viewers for tuning in today. Once more, wealthresearchgroup.com. And I will have links to all those individual direct reports. Go ahead and check out the links. You'll gain a ton of knowledge, which will just be more tools for your tool belt to help you take on your personal finances. So thank you, Lior. Thank you for your time. I look forward to talking to you again here soon. And thank you all for viewing today. Hope you all have a great day. Take care, my friends.
Thank you for watching our video. I hope you subscribe to our YouTube channel.